G'day, Chris. How are you today?
I'm okay. Yeah, all things considered. Yep.
It's been a busy month, hasn't it?
It has.
Yeah.
Wild.
Yeah, well, I think, here we are, the 1st of April, and I think probably importantly that we flag this from the outset, that it is the 1st of April. This is not an April Fool's Day joke, but more importantly, the time element of this recording, because we're very mindful that things move and change very quickly in a world where Donald Trump is doing as he seems to want to do.
Yeah, absolutely. Yeah, it's one of those, he might come out in the next hour or two and tweet something on Truth Social saying, that's it, it's done. Or conversely, go the other way. It's just, we're going to have 1 million troops on ground in 6 days. Like, who knows?
Who knows?
Yeah.
Yeah, I think, perhaps it'd be interesting to maybe reflect on the last month. It's been a challenging month for equities and bonds.
Yep.
And then perhaps, sort of work our way through where we think this all heads, if we can even be as presumptuous as to think that we know where it's going to head, Chris.
Yeah, I do. I don't think I would even try at this point. It's probably too hard. But I think there's a range of potential, I guess, outcomes in a logical world. Whether the logical world actually holds up, who knows? But
Yeah, I agree. We've been talking in this forum for quite some time. That the backdrop of the economies of the world have been improving.
Yep.
Post COVID into high interest rate environment in 2022, down to cutting rates globally. We've seen economics look better. Equity markets have been really strong, but we have been talking about for quite some time the notion that a geopolitical shock was a very real consideration or factor given the personalities that are controlling the world at the moment. And I think sadly here we are with, sort of in week 5 of a conflict with Iran. And, it's been a pretty bumpy ride for the equity markets. I think, what have we seen, maybe 7% slide in S&P 500 and the All Ords here in Australia for the month of March. And I think statistically that's roughly around one of our worst months since 2022, when obviously we saw interest rates rising rapidly. So it's been a bit of a tester for investors once again, mate.
I think so. And in terms of the zeitgeist out there also, I think just the uncertainty and obviously petrol prices being the really prominent issue. I think it's just created a whole level of uncertainty for lots of people, and coming back to that initial discussion about Trump himself and his unpredictability, I think it just creates a sense of uncertainty, which, as we know, markets hate uncertainty. So
yeah, I think that's and we all feel it, right? Filling up for diesel at $3.19 a litre, it's expensive at the moment to operate, and I think history always shows that when you have those moments of uncertainty that humans react in such a way where we kind of retreat a little bit.
Correct.
And bide our time for a decision of any nature. And I think that's kind of broadly but potentially a longer term risk of this looks like for businesses and households alike.
Well, it's interesting because I think when we go through the slides, that I think that's already kind of showing really. So
that tick down in consumer sentiment.
Yeah, correct.
Yeah, I think I've been reflecting on this a little bit, and the conflict itself is quite shocking and distressing really when you see things being blown up and missiles being fired across the world, and even the fact that we've got a counter about how many missiles Iran have got left, or absolute strikes on places where missiles have been launched from. It doesn't make for enjoyable headlines by any stretch, and I think what I've observed, and I think what we talk about quite a bit here with our clients, is that the initial impact of the conflict and the market reaction is always similar insofar as risk assets immediately slide, and then it takes a bit of time to process what this actually means. And I feel like where we're starting to get towards now is that initial shock. A month ago, saw equity markets slide immediately. We've had sort of little rallies up and down or slides in that month since then. Here we are today on the 1st of April, and equity markets are up strongly today. US was up significantly overnight on a rumour that Iran and the US are, discussing their 5 points versus 15 point, peace agreement, well, not even a peace agreement, just simply ending the war.
Yeah.
But I think what the conflict has actually shown us is that the conflict is a factor in this. But really, where we're now living, exactly to your point about fuel prices, is the cost of oil, and the longer term impact of this oil shock is probably where we should spend some time discussing today, because I feel like that's really centres around what happens for investors moving forward.
Yeah, absolutely. I don't want to say that that's necessarily a concern, I suppose, but I don't want to use the word concern because I guess it conveys a sense of worry. But the impact of that, especially on inflation in the long term, is going to be really important for what the next probably 12 or 18 months looks like.
Yeah, I think concerns, fair without imposing worry, but it's a reality, right? We're dealing with an unknown outcome today, and what we have learned from history, I think, is reverting back to 2022, and I feel like it's important that we maybe just talk about the fundamentals in some respects, because seemingly equity markets do not like an environment where interest rates are rising or there's uncertainty with inflation and the outlook for interest rates is unknown, because exactly to your point before, people don't make decisions when they're worried about things.
Yeah, absolutely.
Yeah, so we'll see where it lands. I think the oil price today was at $104 a barrel or something thereabouts, and at our last investment committee there was a discussion point, and I actually found this a really interesting stat, and it was something like for every 5% increase in the price of oil, it contributes about 0.1 to inflation.
Yeah, interesting.
So 5% increase in price of oil was 0.1 in inflation. So that was around about $80 a barrel for at the time for oil, and here we are at 105, let's say, between 100 and 105. So the inflationary impact of this is meaningful. Yeah.
Yep.
And I think in terms of the inflation, I mean, different parts of the world some are more sensitive. I think Australia is very sensitive to inflation.
Yeah, correct.
I did note that during the week that the US were out talking about maybe looking through this inflationary shock, which the market really liked, because they were sort of maybe not knee-jerk reacting to what they felt was a reversible point in time. Whereas in Australia, we already had high inflation before this happened at 3.8, and we've had a last read now down at 3.7. We add this into it. There's some forecasts that we're going to hit 5. In inflation again. So the interest rate is out of the hat again, isn't it?
It is. It's just interesting. How the banks then react to that, right? So if the Reserve Bank just decides to go with it and raise interest rates, then you run the risk of kind of crushing everything, really, don't you? So it's like the hard part is just not knowing how long the shock lasts effectively. So it's difficult at the moment.
Yeah,
it's difficult on many fronts.
Yeah, I think you're right. Like how hard the banks go is, it's a hard one, isn't it? Because it's essentially like in the economic context, I'm sure what we'll find is that whilst the banks, they'll probably follow suit with whatever comes, but as a household, we all have our own requirements.
Yep.
We will always prioritise the things that we essentially need to survive.
Correct.
Insurances, groceries. We'll still bemoan the price of fuel, but we'll still fill up if it's available because we need to move somewhere.
You have to get around. Yeah, correct. Yeah.
Where it hurts is in discretionary spending items, right? Yep. So I feel like these inflationary shocks are so unfair to parts of the economy because some feel it harder than others, and that's something we need to be mindful of moving forward. I dare say.
Yeah, absolutely. Yeah, it's just a large impact, right? And I guess the uncertainty makes it difficult. But I've been kind of having a conversation with clients over the last few weeks, and I think back to this is slightly different, this scenario in terms of conflict. But if we look back at when Russia invaded Ukraine, and I know that we came out with a report at that point around, the first 3 to 4 weeks is really the strong negative downturn, and then there's a period of stabilisation, which I feel like we're kind of sort of in now. Where are we? Where are we going to? But I guess strictly from a conflict perspective, then the average time that it took the market to get back to where it was, I think from memory, I have to go back and check on this, but it's 56 trading days to go back to where it was. And it's just in terms of been keeping that in the back of my mind, thinking about how that sort of plays out and sort of what the last maybe week has looked like. And I think I'm just sort of looking at that going, okay, interesting. But then, yeah, we didn't specifically relating to the, that's looking back at all of the data from the last 100 years of global conflicts. I haven't gone in and looked at that and to see, what has that meant for like oil supply at that point in time, but it may not have the particular dynamics that it currently has. Just interesting in terms of, keeping, an eye on that just to see how that plays out over, the next month or so.
It's a good shout out actually, because I think, we're probably the most boring investors of all time, right? And our message will probably invariably never change in moments like this. But I hadn't seen that stat, heard that stat, but I like that insofar as it reminds us very quickly that timing of a market is very difficult, but time in the market will actually be okay. And I think, right now, if anything, I take a degree of comfort by knowing that our portfolios are heavily diversified. Yep. We're not tech heavy, we're not resource heavy, we're not financials heavy. We have market weight across all of those areas, and I'd feel very nervous right now trying to pick the cycle of, the tech boom that we've had in the AI sector now is feeling a little bit of immediate pressure because of the cost of capital for tech stocks is rising. So they're feeling a bit of pressure that resource stocks are kind of coming back into vogue again. Financials are suffering. I really would dislike being on the side of the coin of which one of those do I want to be invested in on any given day, because your point earlier, and I think it's probably going to be a thematic, is the unpredictability of the leaders right now means that things change on a day, let alone a week. So picking and choosing which part of the market we're in.
Who's going to win, who's going to lose.
Yeah,
I'm with you on that front. I think I probably haven't necessarily thought about it consciously like that, but the level of comfort to know that, with the diversity across, geographies and sectors, that when it recovers, because it's not a matter of if and when, like even if we go and doing a bit of research into this, even if you look back at history at the really high inflationary environments, it's still assets that improve during those periods, even though it's economically painful, and we might end, not saying that we're going to, but in those instances in the past where that has happened, if you then go back and have a look at what has actually performed well during those periods, is typically physical and property and shares. Yes, there's volatility, but if you look at it through the full lens of it, the best place to be is to be invested. So
it's interesting, and I think we talk about this in a fairly pragmatic sense insofar as at the end of the day, having a plan for volatility, which we all have in our portfolios with clients and what have you, I think it actually helps process and understand a way through the volatility.
Yep.
Because at times people say, "Oh, should I jump out of equities and go into cash, or jump out of equities and be in gold," or those sorts of things. It's still making a strategic or a tactical decision in regards to where you think this is going to land.
Yep.
And let's use gold as a simple example. The gold price has been rallying at the same time equities have been rallying, which is a bit of an anomaly up until this point. The conflict commences in Iran, the gold price immediately spikes because it's a safe haven. People rush to safe havens. Yep. But then exactly to that cycle you were talking about before about, kind of let's assess the impact. Then you go through this moment of time, how it recovers. The gold prices are reversed very quickly now because the market is now pricing that the conflict will end at some stage. But the longer standing view of this is that what's happened with inflation and the oil price, which is not a great outcome for gold, right? So gold starts to roll off.
Correct.
So therefore, my point in this is that ultimately trying to make a strategic decision around leaders that are unpredictable is almost impossible. I think it actually is impossible.
Yeah.
So that the diversification of portfolios is actually what helps get us through these moments of their worry and they're fearsome. But ultimately, sound diversification helps work through that time.
Yeah, absolutely. Yeah, couldn't agree more. Yeah, nothing really more to add there. So
it's
that level of comfort is nice, and hopefully clients, as we're talking to them along the way, are feeling something similar, even though portfolio volatility is quite high. One of the other things that I've been reflecting on too, which we talked about very briefly before we started recording, was that although March has been terrible, contextually over the last 12 months, or even if you think about year to date, calendar year to date, it's not as bad as it seems.
Agree. It's interesting, isn't it? Like I was having this exact conversation actually with a client the other day, because it was less than 12 months ago that we had the tariff rollout on the world too, right? And that in market context has been bigger than this market movement right now. So the last 12 months in terms of investment return includes a drawdown of nearly 20% on equity markets when the tariffs rolled out, and now a -7 in March for the conflict in Iran. But from point to point, it's actually still a pretty healthy.
Yeah, it's like 7 or 8%.
Yeah, and it's like, if you're sort of thinking about that, and if you were in a coma for that whole time and you woke up and saw all your return was 8% for that 12 months, you'd probably walk out of that knowing it felt pretty good. You feel happy about it, and at the moment, going back to your point before about the unknown is what actually makes us emotionally feel a little bit harder, or reflect harder rather at these points.
Yeah, I think that, and all the standard behavioural biases like anchoring, I suppose. So everyone kind of goes, "Oh, the high was here, and now I'm here, so I've lost this much." But then if you change the framing of what you look at that in, it's a very different story and drives a very different emotion set, and that then drives very different decision making. So I think if there are clients out there who are particularly concerned at this point in time, I think the thing that I would be saying to you is you just maybe change your framing of reference that you're looking at this in, either in 6 months or 12 months, or even 3 years. The 3-year outcomes have been phenomenal, even though we've had all this turmoil in the world. So
I mean, and this is probably our bias too, Chris, to be fair, because we are believers in long-term investing, of course. But I mean, again, time will show that the world has withstood issues of this nature in the past, and again, right now we don't know how this all plays out, but we'll see volatility. I think that's the genuine outcome for now, is that volatility will continue to be high, and volatility, by definition, we think about it mostly in the context that things are falling, but there's also, I would argue today, the Aussie market at the time of recording is up 1.6 today. Last night the US was up 2.5. That's volatility as well, right? A quick spike back up is volatility. So we could be sitting here in a week's time and have had 5 trading days of plus or minus 2% in a day,
and still be at the same level.
And it's just an unpleasant cycle to go through. But maybe we should spend a few minutes talking, Chris, about the sort of scenarios, and we can share a slide as we're talking through this in regards to, I guess the work we do with Willis Towers Watson to provide some information to us to try and share with all of our clients in regards to the scenarios or the likely outcomes that happen in these moments. And I think you'll see on the slide that the sort of base case that the majority of the world is seemingly pricing in is a contained retaliation from Iran. We're seeing right now sort of a softening of week 5. We're seeing a softening or perhaps a negotiation cycle entering, and the slide that you'll see here is the forecast of 4 to 8 week conflict, which we'll see as we're witnessing and experiencing this kind of volatility cycle. But I don't know, how do you see that, mate? Do you think that's a reasonable sort of position where we, in fact the slide there, maybe we talk about this, the indicators of what the US are likely to do. I think that's a fascinating thing in the psyche of Donald Trump, right?
Yeah, it's a difficult one, isn't it? The thing that I've been thinking about during all of this is that this is not just a US and Iran. I feel like there's also some greater undercurrents sort of with China and Russia here, and occupying America in conflict, and what that does in maybe a longer term context. So I've been looking at this and thinking, look, contained retaliation, which is the top one, would be great. And I agree with you. That's the one everyone's kind of pricing in. Just more keeping an eye on maybe like some of the larger undercurrents, which I think might probably drive into your question around, what's Donald Trump going to do. Just too hard to tell in terms of, who's in his ear.
That's right.
What's actually influencing them. But around expectations, I guess it's one of those things, isn't it? I'm hoping it's contained retaliation.
Agree.
Or
Yeah.
maybe a slight bleed over that 8-week disruption. But I think ultimately, the world needs oil supply to continue, essentially. And just thinking about if the oil supply through the Strait of Hormuz continues to be disrupted, well then, currently what is happening is that supply chains in other areas are being set up as contingencies. I guess the question is, well, how long do we get those contingency pipelines up and running to establish enough of a supply where it's less impactful, I suppose?
Yeah, that's sort of starts to bleed into material disruption, right? Like, where we have these long, and I think exactly what we're talking before is, and I guess what I enjoy from this slide here is that the likelihood of that seemingly the world, and this is not just, Chris and Shane talking about this on a Wednesday morning, the world seemingly feel like that's a less likely outcome. It's still a very possible outcome, but a less likely outcome. What I feel, one of the interesting points in this slide is that the US are likely to claim that victory no matter what happens in this instance, right? So, and I feel as though for Iran, they'll also be trying to claim victory in some way, shape or form. And I note this morning that the Parliament of Iran have passed to charge a levy to pass through the Strait now. So perhaps that might be their economic windfall, and all of this is that now. So there's, again, the cost of doing business in the future. The oil price is one factor, but if you now have to pay a levy, every ship that goes to the Strait has to pay a levy to get through. That will be passed on and knocked onto somewhere.
Yeah, it definitely will. I guess then it depends on the size of that levy, I suppose, and then it's interesting. I wonder whether we might bleed into one and the other, but then there's a relatively quick move back to contain just because the world adjusts. Like, I think one of the things that most people forget is we're quite an adaptive species, and we have very short memories too. So, you just think that, even if there was a slight increase in the cost to do it, if petrol prices per se or supply is basically put back to sort of within 90% of what we need, and your petrol price is not $3 a litre, it's maybe, $2.15. Everyone goes back to normal pretty quickly, and subsequently markets then also do the same.
Yeah, that's a good shout out, mate. I hadn't thought about that until you said that just then, but I was thinking in my brain that we had a similar scenario to your point for when Russia and the Ukraine conflict started. The cost of fuel rallied immediately after that, and hasn't really gone back to a pre-level before that. But exactly that, you get used to $1.75 beforehand, and that's a normal price to pay. Whereas 10 years ago, we'd probably be a bit mortified by that.
Yeah, exactly.
But the world does adjust. But that's inflation, right? That's exactly the risk that we run now, is that how far that inflationary bleed comes through, because all that cost it's knocked down the road to the consumer some way, shape or form. And
I note that there's been lots of articles during the week about that's going to impact food prices. So we start to see those costs rise in the supermarket, and then the Reserve Bank's got some, I guess, decisions to make, because it's not just a fuel supply spike. It then becomes embedded into, I guess, cost of other goods, and then what that looks like and whether that can get contained, I suppose. So there's a lot of variability in here, but in terms of from an immediacy standpoint, it's more about moving from, I guess, quote unquote, like crisis mode into something that becomes a bit more business as usual, and how markets, I suppose, react to that. But
it's probably maybe a good way for us to sort of think about wrapping up here, because I think that's a good summation, is that we've probably lived through crisis mode for the last month, in terms of the conflict, and the markets of again a 7% drawdown is unpleasant, but not catastrophic in the context of the market cycle. But really, I feel as though the most boring thing that we'll ever say to all our investors is that let's not deviate at this point in time, because
not at all.
Diversification works. We know having a plan in place helps us work through periods of volatility, and that's not being dismissive of the conflict by any stretch, or dismissive of the risks that are present out there. but planning through periods of difficulty
Yep.
actually allows us to process, not us as in you and I, but
No,
humans
no.
to process
Yeah,
the way through, and calm heads prevail in times like this, and I feel as though that's the message that we'll consistently continue to talk to.
Yeah, I think so. And just as you were talking, I was just thinking about framing as well. Is that I think what happens during these periods is that because of that uncertainty and fear emotion, the reference point that everyone starts to look through this, I know I was talking about this previously, was in, like, if you look at performance, backward-looking performance, also is the same for, I guess, if you think about how we're building portfolios for longer periods than the next 12 months. So, like, we're building portfolios based on what's going to happen over the next decade. So I guess you look forward at that and say, well, yes, we're in a current crisis position, but in 3 years' time, all of the sort of mega themes that we've been previously talking about before this conflict arrived come back into the fore in terms of, well, what does that then mean for specific companies or just the world as a whole? Making sure that we're not. This feels really flippant to say this, but like jumping at shadows, I guess in the shorter term, because I don't want to describe the current environment as jumping at shadows, but I think it's just really important to again contextually look at the design of the portfolios and the mandates we've provided aren't in a 12-month context or in a between now and December context. We're building these to come through these shocks, knowing that they will come every few years as we go through the next decade.
Yeah, I think that's the one thing that's certain out of this is that more of these shocks are they're faster now. Talking before, like 12 months ago, tariffs was the discussion of the day. Now it's Iran. In the next 6 months, it'll be something else. It will consistently be present. But look, I think that's a pretty good message for all of our clients who are listening in. There's one other little thing I wanted to share, and I thought this is one for the good guys today, Chris, is that I see the RBA have abolished transaction fees on some of the tapping at the cafe or the sandwich shop each day.
Yeah, amazing.
Feels like one for the good guys there.
Yeah, absolutely. That just seems a bit. It's a bit like ATM withdrawal fees, isn't it? It's
an unfiltered tap now. You just tap and you sort of have no idea what you're paying at the end of the day.
Yeah,
but,
correct.
The RBA acknowledging that and putting a ceiling on that is a bit unpopular with some, but I think for all of us as consumers, it's very popular for us.
It's just about fairness, really, isn't it? It's like,
yeah, we don't necessarily need to be paying the frequent flyer points to the business owner who's charging us 2% surcharge to buy a cup of tea in the morning or a coffee in the morning.
I was thinking that in my head, but I wasn't going to say it.
So that's my cynical side coming, Chris. But it may or may not be true, but I feel like there's pockets of the society that
I think so, absolutely. Yeah. And I think also it helps in terms of governments come out and cut the fuel excise in half for the next couple of months at least.
Yeah,
that helps too. So
free travel in Victoria for a month on trains.
Yeah. Just the little bits and pieces, I suppose. Whilst we get through this period, I think just try and look at the positives. We're not getting bombs dropped on our heads, which is probably the biggest positive, really. So
most definitely, yeah. But look, I enjoyed that chat today, Chris. Hope everyone enjoys it out there. And, let's keep in touch. If you've got any worries or concerns,
absolutely,
please touch base with your advisor and talk it through. And as we spoke before, I feel as though our message will consistently be remain calm. Let's work through it. Process our strategy in place for portfolios and broader life strategy. And I'm sure there's common sense in there that the outcome will be okay. Thinking 2 or 3 years out and making sure that we keep our eye on the longer term position.
I've got a whole thing about portfolio structure there, but I think we just wrap it up.
Thanks, Chris.
Thank you, Shane. Talk to everyone soon.
Okay, bye for now.